Hi, and welcome to the Steve Jacobson Group website. I'm Candace Glasgow. I'm the Executive Assistant for the Steve Jacobson Group. Limetree Lending has provided us with a wonderful and easy to understand video about the 203K FHA loan. After you watch this video and you have any questions, please give us a call at 303-980-4141. If you want to talk to Steve directly, hit extension 1. If you'd like to talk to me, I'm extension 2. And we really appreciate you giving us your time and your energy to watch this video. And again, if you have any questions, give us a call. Thank you.
What is an FHA loan and how does it work? FHA stands for Federal Housing Administration, and it's part of HUD, Housing and Urban Development. Most people think that FHA is providing the money to the public when they buy a house. FHA is actually an insurance company, providing insurance to the bank when they lend money to the public to protect them in the event that someone were to foreclose on a property. This is referred to as mortgage insurance. Let's look at this in a little bit more detail. When you receive your loan, it's going to be from the bank that you were approved by, and then FHA is going to insure that money. Now the thing with mortgage insurance is this is the only insurance you pay for that doesn't benefit you. Mortgage insurance is to protect the bank in case you were to default. But when you make your monthly payments, you are going to have monthly mortgage insurance as part of that payment. And I'll walk you through here in a second what that looks like. What are the main advantages of FHA loans and what are the main disadvantages? The main advantages of FHA loans is overall it's an easier loan to qualify for. You only need 3.5% down payment. Now if you don't have the 3.5%, you have options. You can get gift money from a family member, or you can utilize any of the down payment assistance programs. Credit criteria is a lot less than other programs. You don't have to have the perfect credit score to qualify for FHA loans. You even have the option of having no credit and qualifying for an FHA loan. The other part with credit is FHA loans are not credit score driven, and what I mean by that is if you have a 640 credit score or a 740 credit score, you still get the same great interest rate. Whereas with other loans, as your credit score drops, your interest rate will go up. So that's a huge thing, a huge advantage of FHA loans. You can have a co-signer if you don't have enough income to qualify. Again, like I said, gift money if you don't have your down payment money. They're overall, as I mentioned, easier to qualify, and what I also mean by that is debt to income ratios. You might be able to qualify for more of a house with FHA loans because they're not as strict on debt to income ratios. The types of FHA loans, there's quite a few different types of FHA loans, and I'll touch on that here in a second, but you have the ability with one type of FHA loan to buy and fix up a property all with one loan using the money that the bank set aside for you to repair, update your house. That program's super popular. FHA loans are assumable. What that means is when you go to sell your house, the new person buying your house can take over your loan, the portion of your loan, at that interest rate that you have. So say you have the opportunity to get in now and rates are low, and 6 years from now you sell your house, rates are back up to 10%. You can actually use your loan as a sales tool to move your property, buy this house and have an interest rate at 5% when the current market at the time is 10%. That's such an opportunity. With FHA loans, you can buy multi-unit properties so long as you live in one of the units. So say you bought a fourplex and you lived in one of the units. That's absolutely fine, and you still only have 3.5% down, and it's still considered, the whole thing is still considered owner occupied because you're living in one unit. That is a great opportunity. Some of the main disadvantages with FHA is the upfront mortgage insurance. Now, the upfront mortgage insurance is 1% of the loan amount. This is the amount of the 1% is rolled back into your loan amount. I'm going to walk you through an example here in a second. But you not only have the upfront mortgage insurance, but you pay a monthly mortgage insurance as well. I'll walk you through an example of that. FHA loans have a maximum mortgage limit per county, and I'll show you where to look this up and what it looks like. But some people in certain counties, they may want to buy a house and it's over the FHA loan limit. So I'll walk you through that. I think it's super lenient or very flexible on how high they go in loan limits, but that can be considered a disadvantage. So let's figure out how they're calculated. How are FHA loans calculated? Based off of this example, let's do a $200,000 house. Your down payment, $7,000, is 3.5%. Now, if you want to put down more of a down payment, of course you can, but the minimum down payment is $7,000. Now, again, where you get this money can either come from a family member as a gift or from down payment assistance. Now, purchase price minus your 3.5%, that is your base loan amount. Your base loan amount of $193 times 1% is going to give you what the upfront mortgage insurance premium totals. So $1,930 is added back into that base loan amount for your total loan amount. This is what your monthly payments are based off of, is this amount. So as you can see, they are rolling back in this premium into the total loan amount. Now, a couple things to note on the upfront mortgage insurance premium. It doesn't increase your monthly payment by really a lot. It's going to be anywhere from $5 to $15 depending on what your purchase price is. The upfront mortgage insurance premium can be paid by you or the seller. Now, what to keep in mind on FHA loans is you can get up to 6% of your purchase price in seller concessions, and what that means is the seller can pay up to 6% towards all your closing costs, prepaids, if you want to buy down your interest rate, if you a bunch of different things that the seller can contribute towards. Monthly mortgage insurance. Now, how is this calculated? $193,000 is your base loan amount times 1.15%. Divide that by 12 to get your monthly amount, and that's $184 a month. Now, a couple of things to note with monthly mortgage insurance.